Hello and welcome to the Dividend Wave. This channel is dedicated to sharing our journey on investing in dividend stocks. We believe dividend stocks are a good path to building an income stream, and investing in the right companies will generate a growing wave of dividend income over time. We would also like to make it a goal to make dividend investing more science than an art form. So what is a dividend? A dividend is a distribution of a portion of a company's earnings to its shareholders. It's usually paid in cash, and it's a tool in some company strategy to returning value to the shareholders. It's usually decided by the board, and once it's made public, it becomes the declaration date for that dividend. At this point, the amount to be paid, the ex-dividend date, the record date, and payment dates are also communicated. The next milestone in the dividend cycle is the ex-dividend date. So effectively, anyone buying on or after this date will not be entitled to the dividend on payment date. So to make sure that you get paid the dividend, you need to buy shares in the company up to the day before. Usually, the following day to the ex-dividend date is the record date, where there is a shareholder record created so that companies know whom they have to pay the dividend to. And lastly, in the cycle, it's the payment date when the dividend is actually paid to the shareholder. And this cycle repeats per the number of dividends that the company pays per year. So typically in the New York Stock Exchange, that would be 4 for the companies paying dividend. There are notable exceptions like Disney that pays only twice a year. As an example, you have Starbucks below, where you can see the last 4 dividends that have been paid. And the source for it's the nasdaq.com, and I will leave a comment in the show notes so you can follow that link. So onto the dividend wave, still with Starbucks, and looking at their dividend payments per share since August 2016. And plotted over time, this is the picture that you get. The wave effect of a dividend paying company. The peaks are the income stream, so essentially the regular cash dividends paid out, and the peaks are actually growing. So this is the result of a dividend growth strategy. In the case of Starbucks, they essentially doubled the dividend in the space of 4 years. And this is not dependent on share appreciation and trading, but rather buying the share and holding it. So how common is it for companies to grow their dividends consecutively? This is a question of time span. There are about 140 companies that have grown their dividends for over 25 years. These are usually called champions or aristocrats. And these include 3M, which has grown dividends for over 61 years, Johnson & Johnson and Coca-Cola that have done it for 57, and Pepsi and McDonald's that have done it for 40 years plus. So actually these companies here have grown, not only paid a dividend, but have grown the dividend through the oil shock of the 70s, the stock market crash in 87, the dot-com bubble in the 2000s, or the Great Recession in 2009. And there are companies that have a shorter time span of increasing their dividends, but have done so consecutively for 10 years plus. And these include well-known companies like Microsoft or Nike that has done it for 18 years, Costco for 16, and companies like Visa or Starbucks that have done it for 10 years. So once we find companies committed to rewarding shareholders, one metric that we would like to evaluate that company with is their dividend yield. Taking Coca-Cola as an example and looking at their currently quarterly dividends, we see that Coca-Cola is paying 41 cents each quarter. And 41 cents times 4 quarters, that means that Coca-Cola is paying $1.64 in yearly dividend. Looking at the current share price of Coca-Cola, at the time of recording, it was $45.89. And we divide by the yearly dividend, we get to a starting yield of 3.57%. So effectively, this is the return on your investment in one share of Coca-Cola. Now that we've looked at the starting yield, what is the effect of a growing dividend on shares we already own? Let's look at the case of the iconic investor Warren Buffett. Warren Buffett started investing in Coca-Cola in 1988 and holds roughly 10% of the company. In fact, he is such a great Coca-Cola company advocate that when Coca-Cola wanted to launch Cherry Coke in China, they asked him if they could use his face to promote it. And this can is the resulting artwork that got sold across the country. Now, if we look back at our annual dividend of 164, our share price of 45.89, and our starting yield of 357, let's see how that compares versus Mr. Buffett. He purchased in 1988 at roughly $2.50, which corrected for inflation would be $7.20. So we actually see that the yield on cost of Warren Buffett was 22.8%. And that is the power of a growing dividend. So another metric that we like to look at is the dividend growth. If we go back to our dividend wave and Starbucks growing at an impressive rate, and we actually typically look at the dividend growth over the last 5 years. And if we look at Starbucks and Visa, they've actually been growing at roughly 20% a year for the last 5 years. So that means that the dividend doubles every 4 years. If we look at companies like Microsoft or Apple, you see that they are growing in the 10% range. So that means that the dividend would only double every 7 years. And at the low side of the spectrum, we have companies like AT&T or Bristol Myers Squibb that have only grown in the 2% range. So that means that these companies will only double their dividend within 30 years. So in summary, here at the Dividend Wave, these are some of the metrics that we use to analyze the stocks that we like to add to our portfolio. So the starting yield, the 5 years growth, and the number of years of growth. We try to look at them in the perspective of similarities. Is it like a Johnson & Johnson that is a low yield, fairly low growth, or is it like a Visa that is a low yield but very high growth? Or is it like an AT&T that at the moment is a high yield but has been fairly low growth for the past few years? Or is it an Altria that has got both high yield and high growth? So these are some of the parameters that we like. We will share with you more that we use, and we'll try to make more science out of it. Just remember that this is not financial advice. This is purely for your entertainment. But if you enjoyed it, subscribe and give us a like. Thank you and see you soon.